Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. And we're doing tonight's show Zoom style with Evan Lawrence, our great TV producer, away. Coming up on the show, we have Adam Dawes of Shaw and Partners. I'm going to ask him about AI stocks. Are there any AI stocks in the Aussie market we should be looking for? And we'll look around at a number of other companies that I'm keen for discussion on. And then Jason Tay. Jason Tay is the fund manager of the Switzer Dividend Growth Fund. And he reckons that there's basically a blue chip bubble at the moment. Companies have been overbid, and there's a lot more value in mid-cap companies and the odd small cap as well. So let's kick off now with Adam Dawes of Shaw and Partners. Thanks for joining us, Adam.
Yeah, it's great to be here, Peter. Thanks so much.
All right, mate, let's kick off with some interesting stocks. This is I feel at the time there's a lot of stocks that have been either beaten up or haven't been discovered yet. I'd love to find some really good Aussie companies that will benefit from artificial intelligence. But I'm noticing in America, Adam, that there are companies that you wouldn't have instantly thought of being a beneficiary of AI. But I think we're going to see surprise packages in reporting seasons going forward where a CEO will come out and say, oh, well, we've tried this and we've been surprised at the results.
Yeah, definitely. I mean, even to do with AI, I think you're definitely going to see a lot of those businesses really sort of starting to turn around. And, the whole idea of AI is that it's going to change our world, but then drilling down into the actual business, how is it actually going to change? How is it actually going to, and then getting that to work so the customer doesn't feel like they're talking to a computer. Yeah. And that's one of the biggest things. And I think if they can get that right, because you now know you chat to somebody or you chat online, it's to a bot. So it feels like a bot. But the whole idea is that AI now is going to be so professional, it doesn't feel like you're talking to a computer. And that's one of the big things that AI is going to be moving forward with.
Yeah, and I think it gets down to this, mate, that even if you are talking to a computer, but you quickly get the right answer, well, you don't care. As long as you get yourself the right answer and it ends up being something that's a benefit, you'll live with it. But I was intrigued to see last week Adobe had a 14% rise in price, and it basically was that they revealed that AI had given them results that the market wasn't expecting. I think we're going to see a lot more of it over the next 2 to 3 years.
Yeah, and also, I mean, you even look into that a little bit further. JB Hi-Fi is on an all-time high at the moment. The reason is obviously the consumer is quite brittle or quite, sort of a little bit cautious. However, all of this AI technology that's coming through, everyone's updating their computers, getting the new and latest and greatest because it's got the AI capabilities inside it. So you're actually seeing some of these businesses actually doing quite well on the back of or re-energizing that AI side of things.
Is there a company that you think may well be, is involved in tapping into AI that may well have an impact on their final share price?
Well, yeah, I mean, I think we're going to talk about a couple, but I think something like Nuix, NXL is one. We all know the history, so let's just move that aside. And we're all, sort of that. I did buy some for myself, managed super fund the other day. So hands up, I do own this one, but this group has always been around getting all of that data and then actually making sense of all of that data. So, there was this huge, for years, it's been this massive grab of getting your data, but then they really didn't know how to use it, or nobody really knew how to use it or benefit. Now, with AI coming in over the top, they can then go through thousands and thousands and thousands of company or announcements or data to then make sense of it. So Nuix is definitely one of them. And if I could give you one more, Peter, because it's just come to mind, that is EIQ. Okay, E for Eric, I for India, Q for Quebec. Yeah. EIQ is a business where it's all about heart and taking images of hearts from doctors. Now, previously, when you had an image from a doctor, they'd send it away. 2 weeks later, you come back to the doctor and the expert would basically say you've got some heart issues going forward or whatever. Now, EIQ with AI over the top of that can basically look through thousands and millions of images through your heart and make a determination on the spot. So in other words, you don't need to come back 2 weeks later, which is obviously then you could, fall into a heart attack or something in that time. But is now real life time data where the AI can then give you a prognosis pretty much straight away. Now that's going for FDA approval in the next coming couple of weeks. So that's an interesting one. It's sort of 16, 17 cents to keep an eye on.
Yeah. And you often find that FDA approval is a lot easier for a product as opposed to
Yes,
a miracle drug and all that sort of stuff. So
correct.
that's really interesting coming on that one. I asked you to talk about a company like Telix, TELIX. Its ticker
Yep.
code is TLX.
Yes,
Uh,
that's correct. Yep.
yeah, I get a lot of questions about what's Shaw and Partners thinking about Telix.
Yeah, so we don't actually cover it, but I do know a lot of other research houses that do cover it, and I own stock, yeah, for my clients on this one. Look, it's a fantastic story. It's obviously a biotech story. It's got lots of drugs that it's making money in straight away or now. There's a lot of revenue that's coming in the door, but they've also then got these other drugs that they're waiting for to get FDA approval. The stock did get close to $20 and then did slip back a little bit on the back of that they were looking to do a NASDAQ listing to raise another $300 million to keep the process moving forward. Now, we all know when you go to the US, that basically means that you're going to get a higher valuation. But what we read between the lines that they've turned around and they've said they're not going to go with NASDAQ listing because there was too much of a discount from where it was on the Australian Stock Exchange.
Mm,
So our market has taken Telix from, obviously lows up to $20. I think it's about $16 at the moment, but it is a very, very good company. It makes it has revenue. So that's the first thing with a biotech, because you always need to get that revenue in the door. And
yep.
then forward ongoing from that, there's lots of possibilities from further drugs going forward as well. So it's a really interesting one. I've got it for my clients. I'm happy to hold it. I think on any weakness, you'd be able to pick some of this stuff up because it will move forward. But I think I really enjoy the company sticking to its knitting. Yeah, sticking to it, saying, okay, it's not in the best interest of shareholders, so we're not going to go. We're going to say no to $300 million, and we're not going to go to the Nasdaq on this one. So I think that was the right move for them.
Okay. Sticking in the tech space, but not biotech, Audinate's been a great company, recently
Mm.
sold off, and I'm
Yeah.
getting a question from a lot of our subscribers to the Switzer Report. They're asking me the question, is it in the buy zone? What's your feeling?
It definitely is in the buy zone. Our analyst who used to cover this and left Shaw's, on his parting gift to us, and I think Ordinate was $10, he said to us, everybody, you should buy this and put it in the bottom drawer. You will never, ever worry about this stock. Now, obviously, a lot of us did, and we're very happy shareholders at the moment. But it did come from $20, did come down to the 15 where it is at the moment. I think this is a fantastic business. It's a disruptor in the analog space. It's now making everybody go digital. We actually use Audinates in all of our boardrooms now. The sound quality is fantastic and it will continue to do well. So I'm really comfortable with Audinate. It's one of those ones you should definitely buy and put in the bottom drawer.
Okay, of course, it's not financial advice from Doors. It's the knowledge of being a broker and what you like personally.
That's correct. Please seek professional advice before doing anything.
Exactly right. Now, this is one I don't really follow, but once again, I get a lot of questions around it. And I looked at what the analysts are saying, BOE, Boss Energy.
Yeah,
And, look, energy is an interesting play at the moment. And
yeah,
I noticed that one of I was talking to a guy who's actually developed a business of making building blocks out of the residue of what comes out of the coal-fired power stations in the Hunter,
right.
and what he's producing is really light building blocks as a consequence of it. But he also made the point that a lot of these coal companies, and I won't name any of them, they're looking at alternatives to using the stuff that's hanging around the power stations, and it's a big piles of, they don't call it slags with iron ore, but there's a lot of recyclable material.
Mm,
I was talking about one company is doing pellets, and these pellets are actually for cultivating and fertilizing soil. Because remember that the residue is carbon, and carbon is actually
yes.
quite good. And so So I'm looking at energy companies from a different point of view. That they're not going to necessarily disappear. We know they've got more life than we expected because we're not going to alternative fuels as quickly as we. But to discount these companies as sort of going to disappear could be silly. That's just a bit of background. Now,
Yeah.
Boss Energy, what do you know about Boss Energy?
Well, certainly Boss Energy is one of those ones because it's in uranium. So it's had a really good run up with the uranium price. And certainly that has now started to come back a little bit. We've started to see some of these smaller uranium plays getting a little bit touched up. And look, obviously Paladin, the top end of the range there, all coming back into production and all looking fairly good. So everything's starting to move in the right direction. Boss Energy, we have been doing a bit of buying in that one, taking advantage of some of this weakness that we've seen in the market. And certainly the uranium space is one of those ones where it has had a good run. So pull back a little bit. I think it's in that consolidation phase at the moment. I think everybody knows that uranium is going to be part of the energy transition. And so that, I think, is something that you would definitely be mindful of going forward. But yeah, certainly Boss does look good down here. It does have some really good management. Some of the directors did sell out some out the other day. So I think that's probably a little bit added to sort of further of that weakness that's going into the stock. But overall, I'm really very favorable in uranium space. And I think that uranium is going to continue to move higher, albeit it is in a consolidation phase at the moment.
Yeah, it's fair to say Peter Dutton isn't the only politician in the world who's sort of swinging towards uranium. A lot of politicians
I
in
agree.
countries where they, even in places like France and Germany, they're becoming quite realistic about what is needed to make sure baseload energy is supplied. Mate, one
Yes.
last question to you: is there anything else that you've come across your radar screen that you like at the moment?
Well, looking for value, I think, is what the sort of the name of the game is at the moment. Dare I say it, Zip looks interesting down here. I mean, it's one of those ones that's unloved and nobody wants it. But looking at Zip, I'm actually looking at Star Group again. That one again at 49 cents is very, very tough to be investing in. So that's something that I think you could definitely have a look. I think overall, some of those big blue chips have had really great runs. So there's a lot of talk of, is this market going to come back? I think in that mid-tier space, that's probably where you're going to get the most value forward. And another one our analysts just started covering a couple of weeks ago, but Cobram Estate, COB, is the olive oil business.
It's done
Out,
well, hasn't it? Over the
it's
last year, it's done well. I interviewed the CEO when they listed, and
yeah.
I'm sorry I didn't get in. I must say, because food companies often can make mistakes, but the company's done as well as the quality of the oil.
Yeah, so there's a big thing in Italy at the moment because of climate change. They're having to move all of the olive trees from the south to the north.
Mm.
And because of that, it's going to take, olive trees take 10 years to grow. So there's going to be, and I think Italy is the second largest producer in Europe, which is then flowing into the Americas. There's going to be a big supply disruption from some of those Italian producers over the next 3 to 4 years, and hence Cobram should be able to take some more market share. So it looks interesting as well. So there's lots of opportunities in the market at the moment.
Great stuff. Thanks for joining us, Adam. We'll talk to you in a few weeks' time.
Thank you.
That's Adam Dawes of Shaw and Partners. And that's Adam Dawes of Shaw and Partners. Coming up now is Jason Tay of the Switzer Dividend Growth Fund. And he wants to talk about the fact that there's a bit of a bubble with some of our blue chip stocks. Now, joining me now is Jason Tay, the founder of Vertium Asset Management, and he's the newly appointed fund manager for the Switzer Dividend Growth Fund. And he has a very interesting take on what's going on, the strange things that are going on in the market right now. Thanks for joining us, Jason.
Thank you for having me.
So I was looking at your notes, and the notes are interesting in the sense that you think there's some sort of historical repeat of something that was around in the 70s called the Nifty 50 bubble. What in the hell is that?
Yeah, so look, we pretty much have to wind the clock back close to 50 odd years to actually, draw from parallels from back then. So the Nifty 50 bubble, as it was known back then, was like a lot of blue chip companies were bid up to extremely high valuations. Now, in terms of the earnings, they were considered blue chips, so they were very solid companies, as opposed to the bubbles that we often talk about in terms of the dot-com bubble during the 2000, or even the AI boom, which has captured investors' imagination now. But the blue chip bubble, or the Nifty 50 bubble back in the early 70s, was a group of stocks. In fact, there was around 50 of them, which is why they call it the Nifty 50, that was bid up aggressively. And the best example of that was McDonald's. So McDonald's, around that time in the early 70s, skyrocketed, and it hit a P of 60. While over the next decade, the earnings was bulletproof. In fact, it grew at 20% per annum for the next decade. The trouble was, while it was a great company, because that's why it was a blue chip, it was a bad investment, right? Because the price was so high, the valuation was so high that over the next decade, it was still the same share price as it was, in the early 70s. So this is a prime example of how a brilliant company can become a bad investment.
Okay, so I would presume a lot of those companies in the Nifty 50 would have been also in the Dow Jones, because the Dow Jones only has 30 stocks, and you tend to find that they are market leading type stocks, particularly for a certain period.
Yeah.
And so do you think there are parallels you're seeing today in the Australian stock market?
Yeah, so back then in the early 70s, if you think about the Australian stock market, it was pretty much resource based. So we didn't really experience that back in the 70s, while the US took all the headlines associated with it. But in fact, in regards to today, one parallel is that we have this macro uncertainty associated with higher inflation, and which was also prevalent in the early 70s. And maybe because of the macro uncertainty, people are just buying blue chips, irrespective of valuation. So here in Australia, if you think about the big blue chips that comes to mind, you got the Wesfarmers, that own Kmart and Bunnings. They're very dominant, obviously in their respective industries, and Commonwealth Bank. Commonwealth Bank is the largest and best run bank in Australia, right? But I kind of like allude to earlier, these blue chips have now gone to stratospheric heights in terms of their valuation multiples.
And of course, this is really important for you because you manage a fund, for the Switzer Dividend Growth Fund, and the whole idea is to get stocks that will deliver a good and consistent income to investors. And once upon a time, you just couldn't imagine not having CBA in your fund. You couldn't imagine Wesfarmers, many great dividend paying companies. Are you saying now it's becoming, in a sense, a threat to overall returns if you chase great companies like CBA at current share prices?
Oh, look, at current share prices, one should definitely not chase them, because you are risking, poor returns going forward. Now, they may continue to have sustainable dividends, but the yields are very low because the valuation starting point is very high. So, for example, for a very long time, actually, CBA has had a very good dividend yield against term deposits. But right now, when you look at where the share price is today, because it's obviously very elevated, it gives you a little bit more than 3% fully franked dividend yield. Yes, it is fully franked, but it is actually very low. In fact, the lowest ever in history. We've never seen this dividend yield being so low for CBA.
Yeah. And Wesfarmers, I guess, fits the same, but Wesfarmers hasn't been as renowned as a dividend payer. It's been a dividend payer, but not as good as CBA.
Yes.
So what is the strategy for you then? How do you make sure you still can find good dividend payers? Do you effectively avoid the top 20 or 30 stocks?
Well, I guess it's not really like a blanket, outright screen all the top 20 stocks out. But look, there are a few overpriced stocks that sort of highlighted that CBA and Wesfarmers is one. So obviously we're not investing in those two particular stocks, but we can find pockets of value. So there are pockets of extreme overvaluation and there's pockets of value out there as well. So for example, two particular stocks in the portfolio, Amcor and AGL. They both have a dividend yield of north of 5%, right? They're not priced at stratospheric high multiples. Hence, their cash flows are quite sustainable, and your starting point is a lot lower from a share price perspective. Hence, their dividend yield is definitely more sustainable from at these current share prices.
Now, you've, in your notes you sent to me, have basically implied it's going to be that the historical average dividend that was expected from a typical income fund is going to find it really challenging if the fund manager is still buying the same kind of stocks that historically have been very reliable.
Yes, that's right. So there's one thing thinking about sustainability of dividends, but there's another thing about whether that valuation is sustainable or not. So obviously the yield, like I highlighted earlier for CBA, is very low. In fact, the lowest in history because the share price is very high. So to invest at these very high levels, you're putting at risk a lot of capital risk just for a measly 3%, 3% dividend yield. While there are other investments out there where you can get a more a superior yield and obviously just as sustainable as CBA.
How many stocks do you typically want to have in the fund?
It's about 30 odd stocks. So I think with between 30 and 40 stocks. So with that type of range, we get good diversity across different industries and across different stocks with different business models.
Okay. Now, two thoughts. One is part of the problem for our top stocks, because we are so top heavy with financials and materials, and in the age of exchange traded funds, if I put $10,000 into an ETF, the ETF fund manager is going to buy a lot of CBA and BHP because they have to. They buy the index. Is that part of the drive behind this? We won't call it Nifty 50. I must come up with a better name than that. But certainly our blue chip bubble is partly driven by that, I would have suspected.
Yeah, maybe on the edges, I think so. So look, I mean, obviously I highlighted CBA and Wesfarmers. They're both big stocks. So CBA is 8% of the market in terms of market capitalization. It's very, very big. Wesfarmers is about 3% of the market. Now for BHP, which is 10% of the market, when I look at its valuation, I don't think it's ridiculously overvalued or undervalued. I think it's tracking, probably fair value around with iron ore. So look, obviously BHP is a blue chip resource company, but trades with the iron ore price. But but you see pockets of like extreme valuations for some of these industrials, but I don't see it for the resources.
Okay, good point. Now, what about this argument as well? When interest rates eventually fall, and both you and I know they will eventually fall, there are going to be a lot of companies, smaller, mid-sized companies, that may well be on the outer because of interest rates. Have many of those companies actually found that their share price has been affected, but their historical dividend hasn't been all that affected, and therefore there is some value in mid-cap and small-cap companies that have paid reasonable dividends, but have the potential upside when interest rates fall, that fund managers will start chasing that sort of company?
Yeah, look, I mean, typically for small companies, they tend to be more cyclical and more economically sensitive. So generally, they have I guess greater operating leverage on the both ups and downs of the economic cycle. So, but I guess to your point, in terms of any company with a more sustainable earnings profile, which will then deliver more sustainable dividends, then yes, maybe they would, generate more interest. So one stock I could think about, I mean, which is not a high yield stock, but because it's an infrastructure play, is Auckland Airport. So Auckland Airport, its cash flows are fairly stable and it's regulated by the New Zealand authorities. When I look at its share price, it's priced against rates, because they treat it like a listed infrastructure bond.
Yeah, yeah. And so what is arguably, and this is a question without notice, but what would be the smallest cap holding you've got in your fund?
Yeah, so typically we don't sort of delve much into the small company space, but every once in a while we'll look and we'll try to cherry pick what's what's a potentially a great idea for the portfolio. So right now we only hold one particular company, and that's called Light and Wonder. So Light and Wonder is actually a name that most viewers may not be familiar with, but the way I like to describe it, it's like a mini aristocrat. So why is it a mini aristocrat? So quite a few years ago, some senior management left Aristocrat and actually went to a competitor called Scientific Games. They're based in the US, United States, and Scientific Games under new management changed the name, recapitalized, basically started with basically a blank sheet of paper again. And that's why I call it a mini aristocrat. And so this is dual listed both in Australia and the US, but it's classified as a small cap, which we hold.
Okay, great. So one final point, Jason, like amateur investors out there, and I say that with all respect, but because you are a professional manager, professional investor, we're all looking for the same thing. We're looking for interest rates to come down and another leg up for stocks. A, is that a reasonable expectation? And B, when do you think we'll see the interest rate leg up for this market?
Sure. Let me get my crystal ball and get
Yeah, and be
Yeah.
100% right. We're not interviewing you unless you are 100% right.
Yeah, that's right. So, I think when you think about a world where rates will be falling, I guess there's two scenarios, where I think, the two scenarios are soft landing, right? If we get a soft economic patch with rates falling, but it's just it's kind of like slow easing, right? That's probably the nirvana for stocks. Like if that happens, I think you'll see, building boom, housing construction start again without the major impact of a harsh economic slowdown. Now, the other scenario, I sort of highlighted, if we do end up in a harsh economic slowdown, you'll see this is where banks will be punished, right? Bad debt spike. And of course, central banks will try to save the economic system by cutting rates aggressively to save, to save, the fact that unemployment could be spiking, aggressively. So it's a fine balance in terms of what the economic policy holders have to do. But those are two scenarios that we have to entertain when we're investing in the market and understand what's the likely probability path for the market to sort of navigate.
Yeah. And it puts enormous pressure on central banks getting their interest rate cutting guesses right.
Absolutely.
Jason Tay from Vertium Asset Management, fund manager for the Switzer Dividend Growth Fund. Great to see you, mate.
Thank you for having me.
And that was Jason Tay of the Switzer Dividend Growth Fund and Vertium Asset Management. That's the show for this week. Thanks for joining us. We gave you the full show this week, partly because Evan Lawrence is away on holidays, but also I think it's worthwhile showing you what you're missing out on by not being a subscriber to the Switzer Report. Thanks for joining us. See you next week.